Good morning, everybody. Welcome to the podcast. We got a special edition Saturday podcast. Normally I do these during the week, but it was a very turbulent week on Wall Street, and I just basically didn't have time to get one out yesterday, Friday evening. So doing it this morning on Saturday, and you can see on the chart. Probably don't have to tell you, but this is what the markets did. The S&P was down 4.3%. The Dow Jones held up a little more than the other indices as expected, 3.5%, and the NASDAQ down 5.28%. Now you may be looking over to the right here. If we were to continue this pace for the rest of the next 12 months, we would have almost 100% return. So I don't think we'll continue this type of trajectory because otherwise the Dow Jones would be close to zero and the S&P and NASDAQ would follow. But obviously the large caps holding up the best of the three indices, and of course you have emerging markets getting just hammered, materials across the board. You know, we're going to go through a little bit of this, but what we've seen in the last couple of weeks is a little different than what we saw any time in the past few months. In the last few corrections that we've had, they've been minor, but as we've seen those, the selling had dried up. The buying had dried up. So we basically just had people that were long stocks, whether it was an Apple or Starbucks or even the S&P 500, were simply saying, you know what, I've bought these things, I'm up on them, I think they've gone up enough, I'm not going to buy any more. And so you'd see some profit taking come in, but it wasn't an overwhelming selling. Now what you're seeing is that demand still not there, obviously, and now you're seeing the selling intensify and people saying, okay, even though the price have fallen, I think they're going lower and I want to get out. And so that combination of, you know, obviously a buyer's strike and with intensity picking up on the sell side, you have the markets falling at a faster clip. So the S&P 500 here, you know, I drew this line saying, hey, we broke below that trend line and we broke below the 100-day moving average. You know, the question was, were we going to jump up and, you know, when we came down here and go back up to this and then fall? And obviously we haven't done that. We've just continued to fall back down. So now here we are, and you can see the selling has definitely picked up based on the volume. And that's something that, look, if you're looking for an opportunity to buy stocks or you're looking for the selling to end one way or the other, you want to see this volume pick up. What we hadn't seen, and I mentioned this in the last podcast, we hadn't seen any panic. All we simply saw was a more of a methodical selling, just like we saw methodical buying back in here. It was simply just going up a little bit at a time, you know, maybe 40, 50 points on the Dow, or in this case, a few points on the S&P. And as we fell, it was the same thing. We were just kind of going down a little bit, a couple of bad days. It would rally in the morning, sell off in the afternoon, right? And then, but what we've seen here lately, especially this week, is now we're seeing this volume really pick up, and we're seeing a little more intense down days. And now what we have to obviously look at is the 200-day moving average. That is a likely place for support. Now, I don't think it's going to go straight down there. In fact, I think there's probably people betting on that. But I think that what we're going to see is a rally first. I may be wrong about that. I mean, look, at this point, the S&P 500 right now, the 200-day moving average is at 1278. So that's only, you know, 20 points lower than we are right now. So we could open down there very easily on Monday and then see a rally. But the bottom line is we're getting to this point now where the fear's picking up as it has in the past, and we're going to have a rally. So I think, again, if you have some positions that you're wanting to sell, I think you will have higher prices to do so. With that said, if you're somebody that still has not sold anything and you're having trouble sleeping at night because you have too much invested in this market, there's a threshold at which you say, I have to sell something because I can't keep letting it go down. Remember, in 2008, you had plenty of opportunities to sell at higher prices, and it just kept falling, right? There was a place at which you said, I had to sell something. But if you're in a position right now where you have some things, yes, they're going down, but you have some other things like cash, bonds, maybe a short position, whatever it might be, then you have the luxury of saying, you know what, I'm not going to be a forced seller. Because one thing that's happening now that maybe hasn't been around for the last 2 weeks is now what you're getting is forced selling. So you come home, you see on the television that the Dow Jones is down. It had its worst week in several months. So you go, you know what, I should go ahead and sell some of my mutual funds. And this is the retail investor talking. So they call up, they sell the mutual fund. What happens? The mutual fund manager is getting a lot of redemption requests right now. He doesn't have cash sitting around because his mandate is to buy stocks. So what he does, or she, is say, I need to raise some cash to get this money out to these investors that are selling. So he has to sell the stocks that are going down, the very ones that perhaps he'd like to be dollar cost averaging into and buying more. He can't do that. He has to meet the redemption requests. And so what happens is things that shouldn't be going down, or maybe they should be going down, but they're going down at a faster rate because there is forced selling happening. And I think you're seeing that by not only the volume, but if you look at the stocks and the way they're falling and the types of companies that are falling, I think you're seeing this forced liquidation. And you and I aren't forced, we're not forced to sell. We have the luxury of selling, but you're at a point now where if you don't have to sell, you shouldn't sell. Obviously, the disclosure being, I don't know who you are listening to this. I don't know your situation. I'm talking in general. I'll tell you what I'm doing is I'm obviously got stopped out of some things, and I also took some profits on some things this week. And just yesterday, I did cover a short position. I owned RWM, which was a Russell 2000 short position. And I've had that for a while as it was bottoming here. And it was really used for my more aggressive trading accounts that were owning stocks that may be more volatile. This was as meant to be a shock absorber. So I bought this. Now you may look at this and say, well, Carl, I mean, look, this thing looks like it's got room to run, doesn't it? Can it go up to the 200-day moving average here? Why'd you sell it so early? The thing is with short positions, as I've seen over the last several years, when you are short using an ETF like this, oftentimes a lot of people sell them too late. They sell them when everything clears up. And as we know, when markets do bottom, even if it's temporary, it tends to be a V. And when it does that, you give up a lot of your gains, and this thing could pull back very, very quickly and give up a lot of the gains you had. So for me, I sold into this kind of selling climax yesterday, and obviously taking some profits on some things as well and selling some other things for maybe some losses. But overall, just getting my overall book of securities smaller. Selling some shorts, selling some longs, just getting smaller. Now, look, I think if you want to take the aggressive approach, you should be averaging into this market on the long side because there's some things that have just been getting hammered. One thing that I think is interesting to point out, and if you look at it, I think the difference of this year versus last year is the fact that last year we didn't have, and when I say last year, I mean last summer in August, we didn't have companies that were escaping the selling, right? We had, we have some staples holding up. I mean, I'm long Verizon, and you can see Verizon has reached a new high yesterday. Last summer, think about that. I don't know if you remember that, but those days when the stock market was going up and down 400 points on the Dow Jones for 4 consecutive days, there wasn't many stocks on those down days that were up. And what we saw yesterday was we saw gold up. We saw some closed-end funds up. We saw some of the cigarette companies up. We even saw some energy and even some companies that are industrial type names were up yesterday. And then obviously, as I'm showing you here, Verizon. So there's places still to hide. Yes, some of them may be going down, but they're not going down near as fast as the market. That's the big difference now versus last summer. Now, one word of caution: is it just not spreading yet? That's the thing we have to worry about. Is it that those things will roll over? Because remember, in a true bear market, there is no place to hide. Are these the last of the Mohicans? Are these the stocks that haven't gone down yet? And that's something we have to watch. But it is encouraging that there are places where you can still hide and don't have to go to just treasuries. And speaking of treasuries, this is the TLT, the 20-year Treasury ETF. For those that go, well, interest rates are low, they can't go much lower. They're now at 1.7%. And the thing we know, and this is just from the recent past, the thing we know is that no matter where rates are, when people panic and say, you know what, I think that the stock market's going down, and they panic, they tend to gravitate towards treasuries regardless of the rate. And that's what they're doing now. Now, if this was a straight line, you would, and I'll go ahead and draw a straight line for you, but what you would see is if this is a straight line, the stock market right now, or excuse me, the bond market right now, the treasuries, they did kind of break out of this. We were looking for maybe a double top, a triple top, whatever the case, and look, people are flocking to that once again, and this may be your double top over here. So these things aren't exact, but the point is treasuries are really, really overbought. At the same time, the stock market is really, really oversold. So you have a lot of things at the same time that are leading to money coming out of treasuries and into stocks for the short term. That's what I think. And so, but when people panic, treasuries are the place to be. But the interesting thing right now is that, even the John Deeres were up yesterday in a bad market. Even, utilities, a lot of utilities were up. So overall, I think that's a good thing compared to last summer, because last summer was showing you that there was this real just complete meltdown, and I don't see that right now. And so I think that's encouraging, but I'm also watching to see if it does spill over into those areas, and that's something we have to watch, because if it does, then those things that you own that you've been able to keep, that yield 4 or 5% that are very stable, non-cyclical companies, those things would have to be sold as well. But right now, they aren't. You're still able to earn the income and keep those stocks. That's very, very important right now. The things that are getting hammered, which I don't really have any exposure to and haven't for a while, are things like, the material stocks. Now we have seen, and I have a position in GLD gold, we have seen a pop in gold in the last couple of days. The chart of gold hasn't looked real pretty, obviously, but I think, there's a lot of people who hang on to it as a core position, and I'm kind of doing that. I think I'm using it more as a piece of the puzzle, an asset allocation piece, because I feel comfortable owning it when I know that the only way out of this situation around the world of slower growth and too much debt is there's two ways: to do the right thing, which obviously it doesn't look like anybody's wanting to do, or B, continue to print more money and take on more debt to pay off other debt. And what that means is that paper money depreciates. And so long term, I'm still bullish gold, but it's going through you look at this picture long term, it's going through a tough time right now, but it's gone through some tough times in the past, and I don't have a lot of exposure to gold. But you can see here, it had a very tough time in '08. And by the way, in '08, that was a time when treasuries worked and cash worked. You couldn't go to gold. Gold got hit really hard in '08. So if we're entering a period like '08, and some of you I know think that, then gold's not going to be your place to hang out. But I think if it's just a correction, like we've had the last 2 summers, then gold's going to be okay. And you can see here, it's at an interesting spot technically, but so we could see a run up to here and then roll over, and maybe it goes down much further. So we'll have to see about that. But finally, gold is going up, and that again provides you a place. At least this week it did, where you could hang out. You could say, you know what, stocks aren't the place to be. But gold is a place that's okay to be, and we saw some decent volume on the GLD, nothing great, but overall that's what I see right now, is that we have some very stretched indicators, and I don't have time to put them all up, but very short-term oscillators are extremely oversold. But it does look like the 200-day moving average is going to come into play here. It's only about maybe 1.5% lower, 2% lower, so I think it's coming into play. But it wouldn't surprise me to see a bounce first. And then once again, what is the quality of that bounce? And I think when we get these corrections, until you're uncomfortable, they typically don't end, right? And I don't know how the average American's feeling, but it doesn't feel like last August, does it? Last August, the volume really spiked up, as you can see over here. And now that was maybe that was an anomaly, maybe not. But the volume did spike up, and now we're starting to finally see the volume spike up, and you're starting to get a little sense of people hitting the sell button very quickly. And I think that's going to lead to a bounce. When that bounce comes, is it a one of these days where everything across the board is up, it doesn't stop, it's persistent buying, it's a 90% up day? Is it all those things, and that really has 2 or 3 days built on top of it that are straight up? Then you can say, yes, the selling has climaxed. Or is it just, we get 2 days of very mediocre, they didn't close on their highs, all those types of things. Then that will be an opportunity for you to sell into. And if you did short the market and you covered them, that's where you reset your shorts. Okay? And that's what I'm going to be doing if we don't get the rally that we would all want. And frankly, I think there's a high likelihood that we don't get a decent rally, that this is just an oversold bounce. I think there's a very high likelihood of that, given the fact that economically and fundamentally things are getting worse, not better. And technically things are getting worse from the standpoint of they're deteriorating. I don't want to say similar to 08 because I don't want to scare people, but you're getting that deterioration where, this bull market that started in 09 has run its course. It's gone 39 months. That's the average length of a typical bull market, a little over 3 years. And we're there now. So it shouldn't be a surprise that things start to deteriorate. The difference is we do have some stocks that are very cheap in our market, but they can get cheaper. And that's what we have to watch out for. So I don't know what kind of bounce we're going to get, but I do know we're going to get a bounce. And once we get that bounce, then you can set your shorts again. So, if we tend to get a bounce and we get up here, and maybe this 100-day moving average, continues to roll over, and we get up to here, and everybody's saying, okay, see, that was a great buying opportunity. Once that starts to come back down here, that's your opportunity, I think, to short again and do it a little heavier. If you were short this time, do it a little heavier than before. Now, if you're somebody that doesn't have a lot of positions and you don't want to short, fine. You don't want to go net short. You just want to neutralize yourself and just have a lower beta. That's fine too. But I think this is going to be an opportunity to short, especially if we don't get this, real intense buying, which doesn't seem to be coming yet. So watch for that. But ultimately, I think this 200-day moving average is in play. All right, folks. CarlEggers.com, throughatraderseyes.com. I wish I could have gotten to the Facebook today. I'll tell you very briefly, I am not buying any. And the bottom line is, I think there was support there at 38 where the institutions had their underwriters had this $1 billion to support the stock. And look, it went to 38. There was a lot of confusion, a lot of orders not getting filled, all of that. It went up, and then it sold off at the end of the day. I think it's going to find some support, and the reason why is you had a lot of people selling yesterday that did get in on the original deal. Bono had $1.5 billion, the lead singer of U2, of stock. I'm sure he was selling some of it yesterday. So, you got that stock, and you had all the supply coming in, people wanting to cash in, met by retail demand. But the bottom line is it was kind of a dud, and so it takes away some of the glitter. And on Monday, you don't have people coming in there saying, boy, this thing went from 38 to 52. I'm going to buy it at 52 and make it go up to 70. You're not seeing that. So let's see what happens. It's not a cheap stock, but it's a big stock that a lot of institutions have to own, mutual funds and so forth. So I'll let it settle in. You looked at the LinkedIn, the Groupons, and I know this is a different company, but you look at all these other social networking companies that went public and a lot of IPOs, and there's always a better spot to buy them later on. There's a reason that all those people are celebrating on TV because they're selling their stock to you, right? Why are they on TV high-fiving each other? If it was so great, why are they selling it? So they're wanting to cash in a little bit, and you're going to be the person buying it from them. So think about that. I've seen it happen many times with IPOs. Again, I don't have any idea what it's going to do. It's a kind of a crapshoot for the next few days. But it's an expensive stock, and you're paying for a lot of growth. And just take that in consideration. So unless you get in on the IPO of companies before they go public, fine. But rarely do I buy a company right when it goes public. It's just very rare. All right, so I said I wouldn't talk about Facebook, but I did. But I didn't show any pictures or anything because we only have a one-day chart to look at anyway. So have a wonderful weekend. Don't forget Google+. They've updated their stuff. It's kind of neat. Plus Carl Eggers, twitter.com/Carl Eggers. Have a wonderful weekend, and we will talk soon, guys. Bye-bye.